What's up, guys? It's Mark Sebastian, your only option. The VIX is over 20. I'm going to tell you what that means, why it's over 20, and why it's so weird it's over 20, and what I'm doing about it. So with that, let's dig in. All right, so here we are. The VIX is officially back over 20, which, given everything that's happening, I don't think that's a huge surprise. There's a lot happening right now. We've got a presidential election. We've got non-farm payrolls on Friday. And of course, I think the elephant in the room is the conflict in the Middle East. That's really what's driving things. But it's not that simple. There's something really weird about the VIX being so high. Let me show you what I mean. And to show you, I actually have to show you the SPX. So here's the S&P 500. Been just kind of in a slow decline outside of maybe one big move. So the first chart I want to show you, this is called average true range. And what it really does is show you, okay, not like how much is the S&P moving from close to close, but how much is it really moving on an intraday basis? On a daily basis, how much does it move up and down in total? And what I want you to notice is that since September 11th, this number has plummeted. On September 11th, it was 77 and a half. It's below 59 now. So it's now moving at about 1% a day. When you do the math there, that's about a 15 VIX that you'd be looking at. Next thing I want to look at is true realized volatility, sometimes called historical volatility. Now, this one measures how much we've moved from based on a closing basis. We were here yesterday. We are here today. How much have we moved? Well, over the last 20 days, we've been averaging about a 11.5% implied, an 11.5% volatility. Over the last 10, about a 10.5% volatility. So when you look at how much we're moving, when you add everything up, the highest the VIX would be in this environment would be maybe about a 15, and yet the VIX is 20. Why? Well, as I said at the top of the show, the baseline VIX ahead of the presidential election is probably about 16. With non-farm payrolls coming up on Friday, that's going to add in about 0.75%. So all things being equal, right now the VIX probably should be around 16.75. On Thursday, the VIX closed 20.49, 20 and a half. So what that means is this is entirely from the Iran-Israel situation. Futures term structure, we are in full backwardation. The only part that's not is the VIX itself is trading below the October future. But we have a full-on, call it a hockey stick, kind of looks like the Big Dipper. October is really big. There's a lot of fear built up. So how does this play out? That's the part you want to know. There's kind of three scenarios. There's the best case, worst case, and then the baseline. So the best case, Israel does a little bit of saber rattling, maybe hits a couple of military targets, and this whole thing is over. That happens, VIX is back to 16 and a half, 16-ish by Monday, maybe Tuesday. Kind of that would be the best case scenario. The worst case scenario is Israel starts blowing up oil fields. We get there, a 20.5 VIX is going to be low. We might be talking about the VIX being at 30 in a flash. The base is probably Israel does send some real missiles, blow up some stuff, but it ends there. And the VIX kind of sits here for a little bit to see if Iran responds. When they don't, which they likely won't, then things start to ease back. And by maybe not next week, but the following, we're back towards 17 and things start to relax. As it stands right now, the way I'd be looking to trade VIX is with kind of a hedged volatility short. I'd be out buying puts on either the VIX or in something like VXX or UVXY. I'd be buying puts or put spreads, or maybe I would just straight buy something like SVIX with a hedged piece over it. And then the one thing I would definitely want to be doing, because of that ability of the VIX to explode, and because we're so close to October expiration, which is on October 16th, I need to own VIX calls. We saw a massive VIX hedge go up just in case that worst case scenario does happen. I'm going to show that to you in a second here. A trader bought the 27.29 call spread expiring in on the 16th. They paid 12 cents. Pays out $1.88 if things really do blow up. So it's an inexpensive hedge that pays really nicely if volatility absolutely explodes. Something like this as a hedge against a short position in volatility via long S&P 500. That is actually a short volatility position. Or, like I said, a VXX put spread, a VIX put spread, or something in UVXY, something like that could work as well. That would be my approach. My baseline is vol's probably going to drop, but if it doesn't, it is going to go much, much higher. All right, folks. So there you have it. The VIX is over 20. That is I kind of laid out why and why it's really overpriced and the reasons it's really overpriced and kind of how I see things playing out over the next couple of days. All right, folks, I am Mark Sebastian, your only option. Please like and subscribe. If you've got a question or you want me to break something down, leave a comment. I will get to it. Have a great rest of your trading week and a great weekend. Talk to you soon.